Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Friday, March 6th, 2020. And here are our top stories. The Securities and Exchange Commission looks into mutual fund naming conventions, and ESG is on the list. And a fintech darling takes a major hit this week. Well, this is our This Week in Finance episode, and joining me now, he is the Senior Financial Services Editor for LinkedIn, and he's also the editor for the This Week in Finance newsletter on the LinkedIn platform, Mr. Devin Banerjee. Devin, welcome back to the program.
Thanks so much, Jeff. Good to be with you.
It's great to be with you, and I know there's a lot of great stories that you love to cover each and every week in your newsletter and on the program. The first, I think, this week that we're going to talk about is the SEC and ESG. Sounds like a song, right?
Yeah, sounds like a lyric in a rap song.
Yeah.
Lots of news this week, Jeff, but I did want to touch on this ESG topic because it's something you and I and the market has been talking so much about over the past few years. Now about 140 billion in under management across ESG ETFs. Growing about 20% annually over the past couple of years. And finally, on Monday this past week, the SEC came out and said, look, we're seeing all of these funds with ESG in the title, or environmental or social or governance in the title of these funds. It's time to evaluate whether they're actually investing behind ESG themes. And so it started a public comment period, which is sort of the beginning of the rulemaking process for the SEC, the U.S. regulatory agency. And it's basically asking people, do they believe ESG products should follow existing rules, to be honest, for other mutual funds and ETFs that require them to invest broadly behind what their names suggest. So, for example, if a fund has the word stock in it, that fund is required to invest, broadly at least 80% typically in equities, which makes sense. It's preventing false advertising, false marketing, for example. And I think this is a real interesting moment in the evolution of ESG because, as I said at the top of the segment, there's been so much talk, and there's also been this danger of what people call greenwashing, where there's so much interest in allocating to ESG products among asset owners, pools of capital, that there may be some fund managers who are creating products that are pretty similar to existing products, but have ESG in the title or in the name, just as kind of an asset grab strategy. So I think a big moment in the evolution here, and I think we're going to start seeing people encouraged to develop metrics more carefully, ESG data points, so that these things can start being measured.
First, off the top of my head, Devin, when I think about this, I think in general related to the mutual fund industry, a lot of people who invest in mutual funds in 401ks and 403b programs and even in their IRA, a lot of times they try to align with what the name of the investment is. And sometimes there can be a deviation. So that's not the poke at the ESG marketplace, but it really is the poke at the mutual fund industry in general. I mean, I think we need to tighten up the regulations there, as well as legitimize and establish protocols for the ESG market.
Yeah, absolutely. Look, regulation spurs a lot of controversy and very strong beliefs on different ends of the spectrum. But when you're talking about the name of a product and whether it's matching what that product does, I think the majority of people, would get on board with something like that. And we're seeing that in the conversation on the platform. One LinkedIn member came out and said, look, defining ESG should come first. People don't even agree on what an ESG strategy actually is. There was a lot of great conversation on the LinkedIn platform about this. People saying, should rating agencies get involved, or should this just be a compliance with a set of predetermined standards? Or is this about screening, negative screening that limits the universe of in the security selection process? Or should it be a focus on impact investing? Or should it be funds that actually proactively engage with portfolio companies in which they're investing to help them progress along ESG issues? Should it be all of the above? Should it be none of the above? And so it's starting this really actual fruitful substantive conversation around the definition of ESG and what metrics should be in place to measure these things. I mean, that's a conversation that people have been having for a long time, which is everyone's coming up with their own metrics. And so maybe finally there'll be some standardization.
Yeah, I think we need some standardization, but as you just described, I think every fund is unique and different, and it's up to the investor to really understand and do the due diligence, whether it's an investment advisor or consultant who's working with an institution who sponsors a retirement plan or sponsors an endowment or foundation, or it's the individual who is just interested in sustainability. And I think there's some due diligence that has to happen there. I'm not sure, Devin, just hearing the gist of the conversation, that the Securities and Exchange Commission or anybody's going to have a rhyme or reason into how you define these things, because I think it's different, could be different for every person, much alone every institution.
That's absolutely right. And look, I was talking to a fund manager just a couple of weeks ago, Bonnie Wong-Tracul. She's actually the head of ESG investments. It's a title that Western Asset Management, the big $500 billion fixed income manager, has given her, which says a lot about the industry, by the way, that there are now people with that title at big asset managers. But what she was saying was exactly along your point, which is, standardization sounds great, but maybe it's not also great. It's actually a source of alpha for some of these asset managers pursuing ESG strategies, where they have the analytical resources and they have access to management, and they can kind of figure out their own approach to executing on an ESG strategy. So there's going to be a lot of push and pull, but I think this is the start of a really important conversation. And yes, even though there's going to be some, as I said, push and pull, it signifies, I think, that ESG has really come to the fore and is now top of mind for asset owners, fund managers, and now regulators. So it kind of says something about the maturation of ESG.
Yeah, I would just add, I think when I think of standardization, and I'm thinking about that regular investor, right, the mom and pop investor who may have this in their 401k plan or not in their 401k plan, I almost think when you're talking standardization, you're actually talking almost like indexing, right? I mean, that's where you could have some level of, you've got an index, and that broad index tracks ESG or sustainable, companies or whatever. There should be some standardization around that. But I do agree that if a company is an active manager and this is how they deliver value to their clients, I think you're going to have a hard time putting them in a box and having them be okay with that, and then having the investors understand that, and then being the same with all their competition. That to me is fraught with challenges in terms of due diligence.
Yeah, definitely. I think where people are starting to talk about standardization is not actually at the fund manager level in terms of performance reporting and performance attribution, but in the portfolio companies or the issuers in a fixed income strategy. So for them to talk about environmental emissions and other things, for them to kind of have a standardized data points that you report. Is it parts per million, or is it this metric or that metric? And so I think that's where the conversation's starting. But I do kind of agree with you. Everyone's going to have their own preferred metrics. So there's going to be a lot of this back and forth.
Yeah, I see a lot of investment policy statements being possibly revamped. Well, Devin, I want to take a break. When we come back, we're going to talk to Devin about fintech darling Robinhood, and not so great news this week given the market volatility. So stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Devin Banerjee. He's a senior financial services editor for LinkedIn, and he's also the editor, along with his team, for the This Week in Finance newsletter that you can find on the LinkedIn platform. Devin, thanks so much for sticking around this morning.
Absolutely, Jeff. Lots of news this week.
Yeah, lots of great news. And again, people can check out the newsletter for a lot more information. There's a lot more than just 2 stories, but we try to highlight 2 that you believe are really meaningful to the audience, to the broader audience. So this second one, Robinhood, which is the darling of the fintech community and has really resulted in changes among discount brokerage organizations. What can you tell us? What happened there?
Yeah, Jeff, I wanted to highlight the story because Robinhood is, or kind of was, as I'll get to, the darling of the fintech ecosystem. It has amassed north of 10 million users in just a couple of years, a valuation of almost $8 billion among private investors, and it experienced a real problem earlier this week. So Monday, which was a huge day in the markets on the heels of the Fed rate cut of 50 basis points, and actually the largest rally in the Dow in terms of points in history, Robinhood was down throughout the day, 9:30 a.m., just a minute or 2 after markets opened, until 2 a.m. Eastern time Tuesday morning, and then down for about 2.5 hours Tuesday morning as well. And this just sparked mass furor on social media among users, as you can imagine. People were not able to access their accounts, not able to place trades, not able to exit trades either. And you know what this really signifies is that these disruptors in fintech can really use user experience and user interface and some flashiness as an edge. But when it comes down to operating, to stability of the infrastructure, there can be some problems. And this really, as I said, sparked fury among users, many of whom are talking about on social media, talking about dropping Robinhood. Many already have. There are threats of class action lawsuits. People are demanding compensation. So just to be clear, what happened here, according to Robinhood, was some instability in the software infrastructure due to high volume. So obviously big day in the markets, big couple weeks in the markets, and high volume really brought that system down. There weren't redundancies built in, which a lot of people pointed to as something that should have been kind of a first step in the process. Mm-hmm. Robinhood also denied some speculation that it was a coding glitch due to the leap year. Some people were pulling out some source code in Robinhood and saying it had the dates wrong on Monday, potentially due to the leap year. Robinhood said that was not the main issue for the outage. But look, this is a big reputation hit, especially, as you said, many of the other discount brokers have actually followed Robinhood's first competitive advantage, which is zero commission trades. So we've seen Schwab, TD, Fidelity, all the big guys really come out and copy that. We actually saw, I was really interested to see Fidelity on Twitter going into the threads on the Robinhood help account, directing some angry users to call Fidelity to figure out how to move their money. So big day for Robinhood and the discount brokers on Monday.
Yeah, and it's interesting you bring up Fidelity because they just had an outage, I think about a week ago, where 401k investors or I think general investors couldn't transfer. So it's not just disruptors, it's even the more established. I mean, Fidelity is probably the largest 401k record keeper in the United States, one of the largest investment managers, and it too had some challenges. And by the way, they're not the only ones, but since you brought up the name, I figured I would just bring that up as well.
You're absolutely right. We've even seen with Vanguard, some outages. People can't access accounts briefly, but yeah, I mean, to be down an entire day, and actually more than a day on such a big day in the markets, and for a platform that candidly kind of encourages, or at least is best suited for more active trading, even though my personal belief may be that that's not the best strategy for everyday investors to pursue. But a platform that's kind of geared toward that, to be down for more than a day is quite severe.
Yeah, well, I agree on all accounts. I certainly think that people should have access. They were probably anticipating because I think the market really popped on Monday, if I'm not mistaken. So people potentially missed the upside. But I agree, we've got these daily valued accounts. People now carry their devices. They can time the market or believe they can time the market. I'm sorry, I'm just not a believer that is something you can sustain long term. But I do think it's great that people are using Robinhood. Clearly 10 million people up until recently were satisfied. They're engaged. I think that's important in terms of how they're putting money away. I think there's some lessons here clearly that can be learned.
Oh yeah, absolutely. And to your point, I definitely agree, especially on a network like this that discusses long-term investing and retirement issues. I think people considering Robinhood should first check with an advisor or a financial advisor and come up with a plan, have a long-term strategy, et cetera. But I think this just kind of points to, this fintech ecosystem that's really been swelling and that you and I talk about a lot. It's definitely not foolproof, and it's definitely not without bumps in the road. Today, which is Thursday, we should say we're filming this on Thursday, was the first lawsuit against Robinhood due to this issue from a user in Florida, estimating that more than 1 million users were probably affected, with losses probably exceeding 5 million. This is all alleged in the lawsuit. Robinhood, obviously not commenting on this, but a lot of people actually pointing to its terms and conditions, the terms of service, which says pretty clearly that Robinhood is not liable for losses due to technical disruptions. Of course, users, you and I, or at least I'll speak for myself, never really read every single word in terms and conditions, but that is in there legally. But yeah, I just wanted to point out the story because we talk about Robinhood so much, and we talk about it as a disruptor. But some of these more basic issues, keeping the platform up and operating, are still clearly present.
And let me. You said you can speak for me because I haven't read a end user licensing agreement in probably 30 years. So I think you do speak for me and probably for a lot of people. Devin, I just want to shift gears. This is a story that I know you were prepared to talk about. Just with the coronavirus, up and down in the market volatility. Just want to get your sense for maybe some of the conversations that you've seen on the platform, whether it's financial services, which obviously are impacted, people are concerned about the market, but also healthcare and some of the other areas that the team at LinkedIn is covering, because you have counterparts in these different areas, tech and healthcare, et cetera.
Yeah, absolutely. It's the top focus for our team right now, and probably for most newsrooms. Really fast evolving situation. I think what we're seeing generally is a lot of strain, a lot of stress on infrastructure, on healthcare infrastructure, especially here in the US. Also, just from a workforce perspective, which we here at LinkedIn cover quite a bit. A lot of companies now are having to be very quick on their feet in terms of their big employee workforces working from home. What that means for meetings. We've seen some interesting stories and conversations around, in finance in particular, investment bankers traveling less. There's talk about IPOs being put on hold, including some of the big ones for the year. Airbnb was kind of slated for this year, and both because of the huge impact on its business model due to the huge reduction in travel, but also just because of the capital markets volatility. Some of those IPOs, the speculation is that they will be pushed to next year. Also, big events. We're filming this on Thursday. There's talk of South by Southwest, the huge tech and kind of cultural event being canceled that hasn't been announced. But there are huge ripple effects, for example, with South by Southwest on small businesses in Austin, many of which kind of peg their prospects for the year to this huge week around Southwest. So a lot of travel, the travel industry, of course, flights or airline companies, I should say, taking probably the biggest hit. So lots of strain, very fast-moving situation. But we're trying to highlight, as I said last week on this appearance on the network, we're trying to highlight the most official information at the top of LinkedIn. You can see information coming directly from the CDC accounts, the World Health Organization accounts, et cetera, right at the top of your LinkedIn feed right now.
Yeah, well, certainly a lot of people both impacted from a health perspective, and also looks like the implications economically and financially, more to come on that, unfortunately. Devin, always a pleasure reading This Week in Finance newsletter, talking with you, and getting the lay of the land on the social media platform. Have a great weekend, and we'll talk to you again very soon.
Sounds good, Jeff. Take care.
And that wraps up this episode of BRN AM. And it wraps up our BRN AM shows for the week, but we're not done, because tomorrow we've got our show BRN Weekly, and that's our retrospective look back at the best segments of the week. You're not going to want to miss it. Don't forget, for all the news in retirement, markets, technology, personal finance, and more, check out today's edition of The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Keep on saving, and don't forget, roll with the changes.
Waiting here for you to take and drink of. But if you're tired of the same old stuff.
Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.